Last week, Silicon Valley Bank, following a downgrade in their credit rating by ratings agency Moody's, experienced a run on their deposits that the bank could not meet. It is now Saturday, March 11th, and the story is beginning to gain clarity. It begins in 2019 when SVB saw a tripling in its deposits. It then invested those deposits into risky debt instruments, which, as the Federal Reserve raised interest rates on its treasury bonds, became distressed when the interest rate on the more secure bonds outpaced that of the more risky investment. The credit agency Moody's this past week, after a consultation with SVB's executive and auditing their books, decided to downgrade their credit rating. SVB was found to have billions more in deposits than they had cash on hand, and sought investment from outside sources to bridge the difference until their assets could be liquidated to cover the outstanding deposits. However, the deal was not completed by pre-market trading on the day of Moody's announcement, and when depositors raced to get their money out of the troubled institution, they found additional difficulty in the empty bank vaults. The problem cascaded, stock in the bank tumbled, and those in the tech and finance industry were left in shock as the nation's 14th largest banking institution looked to be on its last legs. That's where we are now. As of Saturday, March 11th, that is where we stand. On Monday, there have been rumors that the Fed will come out and bail out Silicon Valley Bank. It will provide, this is hearsay, it will provide 50% coverage of depositors' money associated with the bank. The additional 50% can be covered, seemingly, can be covered by the bank itself. So this will not spread. This will not be a contagion if the Fed or another large institution, such as Goldman Sachs or JP Morgan, acts in this way. This will stay isolated to smaller banks. Now, there are two ways that this could become a contagion. There are two ways that this could spread beyond the borders of Silicon Valley Bank. More generally, the smaller banks, the mid-sized banks in the Silicon Valley area that supply banking to VCs and, by extension, startups. The first of these is a banking contagion that investors, depositors, writ large, will see investment and deposit into smaller regional banks as a large risk and move their money from those smaller regional banks to bigger banks that can better cover their assets, their deposits, in the case of a bank run. The second is a contagion within the industries that Silicon Valley Bank did business with. The wine in Napa Valley, the VC that is typical of the San Francisco Bay Area. If Silicon Valley Bank does not remain solvent, if it does not have money to supply its depositors, if the Fed or some other institution does not come out on Monday and say the depositors are secure, businesses that are associated with Silicon Valley Bank will not be able to make payroll. They will not be able to pay their employees. They will not be able to maintain their obligations. And this cascades beyond the borders of this one bank. Of the two, I happen to believe that the banking contagion is more likely. I think that the Fed, JP Morgan, Goldman Sachs will choose to act in a way that is financially responsible, in a way that contains this to just the bank and its investors and its stakeholders. However, there have been additional banks that fill a similar role in Silicon Valley, First Republic, Silvergate, and others that have been revealed to be doing similar things with their finances behind the scenes. If First Republic falls, if additional banks also fall to bank runs, consumer confidence in the regional banking industry may be hurt beyond repair. And this creates a very big danger because a lot of banking, especially in middle America and rural communities, is done at smaller regional banks. And if those institutions experience runs on their finances, this could trigger economy-wide effects. We have to see where the story goes. I will be covering it as it comes out. I will make another video on Monday following what I anticipate to be the Fed's announcement or some other large institution's announcement that it will bail out this bank to the tune of 50% of its depositors' money. This amounts to $50 billion. Now let's talk briefly about who is at fault here. Because as you will see in the coming days and weeks, there will be any number of different narratives. It will be the Biden administration's fault. It will be the Fed's fault. It will be the bank's fault. It will be Wall Street's fault. Who is really at fault? It is hard to tell at this moment. However, if you ask me, the banking executives are responsible for the financial solvency of the bank. You cannot blame the Fed. You cannot blame the Biden administration. You cannot blame Wall Street, VCs, Peter Thiel, or anyone else for this bank going under. You can only blame the bank itself. It has to be their fault. They were the ones entrusted with depositors' money, with investors' money, and they played fast and they played loose with this money. They were not able to meet their financial obligations, and as a result, the Fed, JP Morgan, or Goldman Sachs, or some bigger institution is now going to have to pick up the pieces. And we all have to deal with the after effects. Be safe out there. Until next time, I've been Shabby Shambles.